Now we're going to talk about lease options and some other creative ways you guys can buy properties. So a lease option, also known as rent to own, is when property is purchased with an option. So it's not technically being purchased on the front end, but you have an option to buy it later. This is kind of similar to a land sales contract in that a memorandum, a cloud, is against title, and you don't fully transfer title at the first point of contact.
I know with these lease options, they can get a little bit technical. Could you go through some of the main terms that are used in these lease option agreements?
Yeah, so you have strike price, meaning the price the property is to be sold when you execute the option. Then you have your monthly payments, which is through your lease amount. You don't actually have an interest rate in this case. And then you have the option length, so how long you have to execute this option, and then the expiration date of the option. So with a lease option, you are agreeing that you have a certain period of time to actually purchase this property and take title, meaning you're going to go sell the property before that date or refinance it or structure it in a different way. So for example, someone may give you the option to buy a property with a 10-year option, meaning within that 10-year period, you have to reach that price and whatever terms you agreed upon and take title to that property.
So the buyer will have the option to buy at a later date, and all of the terms are negotiated upfront.
Correct. All negotiate on the front end, so you know exactly what you need to do, and then you just have to do it prior to that date. And then if you do not do it prior to the expiration date, the contract is void, meaning the seller still owns that property.
Are the buyers typically doing this to move into the property before ahead of time, or are they doing it to rent the property and subleasing it?
There's a few different reasons why someone would want to do this. So this is a great way to acquire rentals or a place to live in yourself. So the benefit would be you can leverage into a deal like this, right? So you can come in with what's called the option fee. So the option fee is similar to your down payment and can translate to your down payment later on. So I could give a seller an option fee of $20,000, which gives me the right to purchase this home within X period of time for $400,000 down the road. And then we can contribute that towards our down payment. So you can leverage in as one benefit, or you may not qualify for a property on the front end. You may have some cash, and you could go do a lease option and you know you'll qualify within 5 years for a property. So you set up with a lease option and then you can refinance the property later on and put a new loan on it.
Got it. So when thinking in terms of we're trying to create win-wins, the seller, they get that option fee, so they get cash up front that's generally non-refundable.
Correct. This option fee is non-refundable. So if you don't execute your option and purchase the property by that date, the seller gets to keep that money.
So that's awesome. And then they also get a rent payment that can be at or above the mortgage. So they're getting monthly income, they're getting an option fee, and then if you buy it or not buy it, they still get to keep that. And then they also get to retain title typically, so they retain control of the property.
Correct. So with that option fee too, that's tax-free money that the seller receives until the option is recorded.
That's nice.
And now the buyer is making a lease payment to the seller, meaning they can collect a spread if they have an existing loan in place, or maybe it's one-to-one. It's all negotiable. So the seller could make additional money. And the strike price, so the price that the option is executed at, could change over time. So you could set a $400,000 price in year one, and you could say, hey, this price is increasing by $10,000 per year until you execute the option within 20 years or 5 years, whatever it may be. Or this could be a decreasing strike price as well. So if you're a buyer, you could go structure this deal with a decreasing strike price and take advantage of that seller's loan pay down over time.
And the pitch there is saying, hey, I'm paying down your mortgage, you're getting $500 a month in principal pay down, I want to decrease the strike price by $500 a month.
Correct. You could structure it that way, or maybe it's $300 a month or whatever it may be. The cool part about these is they're all 100% negotiable as well.
Yep.
So this is an example of a single family home I actually bought on a lease option. So with this house, we bought it for like $300,000 or $315,000. I don't remember exactly how much. And we only put $7,000 down as the option fee. So this was a property that was just on the market, and they actually had no equity within this property. So they had a super low rate on it, and we wanted to purchase it subject to on a wrap potentially and take title, but it didn't make sense in their specific case because they wanted to go qualify and buy their next home. So for them, structuring it as a lease option, let the lease come in place, cover their mortgage, allowed them to go buy the next property, and us take control of the property and the right to purchase it later on. So we got the benefit of their low interest rate. we got to collect the spread on what we were now renting out for versus our payment on the lease option. And then they got to solve all their problems of being able to buy the next property. And when they were trying to sell this thing, they were going to have to write like a $30,000 check to sell it. So it was a win-win for both parties.
So they went from having to write a $30,000 check to getting $7,000 in their pocket. They were still able to qualify for that next house. They were pumped.
Yep. And then we just did this as a decreasing strike price over time, following the amortization schedule of the loan they had in place. So it's essentially like we had that loan.
So when you go to purchase, that $7,000 was used as your down payment, but at that point, did you need to come in with additional funds?
Nope. So just that $7,000 and that was it.
Awesome. So Trevor, you had your $7,000 option fee. When you go to purchase or execute that option, did you have to bring more down to the table?
So I haven't executed this option yet, and we set up the option length to be longer than the existing loan in place. So if we were to execute that option prior to having enough equity in the property to refinance, potentially yes. But in this case, our plan was to hold it over the long term and take advantage of that low interest rate for as long as possible. So essentially, we have the option to do this over the full loan amount. The loan will be paid down fully over that option length, and then we don't have to pay anything because it's free and clear.
That sounds like a cool way to structure that lease option.
Yeah.
So the strike price is decreasing by the amortization schedule. You set the option term to be longer than the mortgage. So basically, you never have to execute this option until after it's paid off, and you get to execute it at $0 because the strike price was decreasing.
Correct.
That's cool.
This is another lease option example. This one is a duplex that we helped the buyer and seller with. So in this case, there was $100,000 of equity that the seller had, but the buyer only had $40,000 to bring down as the option fee. So we structured this with a $40,000 option fee, and then there was this $60,000 of equity we had to play with. So we set it up on a lease term that would be equivalent to a 6% interest-only rate. So in this case, there was an existing 3% loan, and we sold the property at a lease rate that would be equal to a 4.5% loan. So meaning that the seller collected a 1.5% spread on that existing loan amount, and then what they had for additional equity, we set up as an additional lease payment on. So as they pay off that $60,000, the lease payment actually goes down. So we did that because we wanted the option fee to be longer, but the seller wanted all their equity out in a shorter period of time.
Got it. So with the seller asking for a higher lease payment than the mortgage, they're basically getting guaranteed cash flow, right?
Correct. So they solved all their problems by getting that $40,000 now. They still generate cash flow. They got to arbitrage their existing loan, and then they get the benefit of collecting an additional lease payment on that extra equity they would have, and then they get that portion cashed out prior to the option being executed.
So Trevor, what happens in a situation where the buyer misses a payment on a lease option? Does the whole option expire and they get to keep their option fee?
Yeah, so within the lease option paperwork, it outlines exactly what happens in those cases. So typically, you'll have X amount of days to cure that if a buyer misses a lease payment. And then if they do not cure the payment, cure the default within that time, then yes, the option becomes void.
So the buyers are very motivated to make these payments because in this case, if you miss a payment, you lose $40,000 of your option fee.
Correct.
Got it.
Now we're going to dive into a few different deal structures you guys can use outside of the ones we've already talked about. So transactional lending is something you guys may have heard of, but it's a really helpful way to close a creative deal. So when you have a transactional lender, you may have a seller carry a creative deal structured, but not the full down payment to cover it. So what a transactional lender does is they come in and lend you money for a shorter time period so you can get this deal closed. We also talked about seller seconds and mixing them with your current bank loan on a property you're buying. Another thing you can do is have a seller second on an additional property that you own. So you don't necessarily have to take it on the property you are buying. So you could do this prior to purchasing a property and have someone lend you money in second position against another property, and you could use that money to close a transaction and leverage into another deal. Another way to think about these deals is once you purchase a property, sometimes the perfect person to borrow from is the seller. They have a ton of money and they may not know what to do with it and may want to collect interest on this. So a lot of the deals you can borrow from a seller post-closing, whether it be on a promissory note, a second deed of trust secured to that property maybe, or a second deed of trust secured to another property. So there's a bunch of guidelines too about these. With conventional loans, you can't typically secure it at the time of closing in second position if you're going past a certain leverage amount. With other loan types you can, or you can get creative and structure these deals in different ways, and each lender is different. So this is something we can help you guys figure out as you go along. This is an example where we use transactional lending to leverage into a deal for a client. So this client only had $5,000. They owned a bunch of other properties, so they're an experienced investor, and they do midterm rentals and short-term rentals all the time. So this thing was 2 cottages they were trying to buy, but weren't sure how to do it. They were purchasing these things for $500,000 and needed $125,000 down. So what we did is we structured this deal for the seller post-closing to carry back $125,000 or so for them, so they could leverage into the deal. But that doesn't solve the problem of not having enough money to close the deal on the front end, and the seller couldn't yet lend them this money because the deal had not closed and they didn't have this money yet to lend. So we used a transactional lender in this case. So because this person had other properties, we just got them a line of credit against another property, which is then allowed by the lender to use as the down payment. So we went and closed the transaction, and now the seller was able to take place of that transactional lender with the loan they agreed to make, pay off that transactional lender, and then that seller now lent secured to that other property at whatever terms, I can't remember the exact ones on this that we agreed upon, but to the buyer. So they were able to leverage into this deal.
For transactional lending, I mean, it sounds pretty awesome. How expensive is it?
That's all negotiable as well. So there's different hard money lenders who will do it and different private parties, but there's people who will collect a certain spread just on interest rate for depending on how long you borrow it, or they may charge you like 3 points on the front end. So that's all completely negotiable as well.
On this transaction, what was the first position lending?
We used a DSCR loan on this property, which is just a specific investment loan. So it's a little different than conventional when you own or occupy properties. It looks at the property itself and how it performs, not so much your personal income. So there's a bunch of other ways you guys can do deals as well, whether you're using private lenders, you're doing partnerships, or using hard money. But I wanted to give you an example of hard money in a deal I actually bought. So this is a fourplex I bought using hard money with $0 down. I was able to use 0 down because they gave me a 100% loan and took collateral against other properties I owned. So this lender took seconds on 2 other triplexes or something else that I had equity in, so they had security there, even though they were giving us a 100% loan on this fourplex. I bought this thing on 100% loan because, as you can see, there's an extra lot next to it, so I wanted to come in, divide the lot, improve the fourplex, and then build on the lot later. So the benefit was I could create a free and clear lot that I could then go leverage further with the bank to build on. So that was a bunch of different ways you guys can do deals. If you want help structuring these deals, sign up below.